is part 2. We're going to start with these revenue recognition issues. They're going to follow the same 5 steps as we've been through, but they're going to be little ones that are kind of a little bit confusing on how they apply to them. So first one we're going to talk about is sales returns and allowances. Hopefully that's what we're going to talk about. So the right of return is granted for products. So we have company returning the product, gets a full or partial refund, credit can be applied, and other products exchanged. We have done this before, so a lot of this is going to be very much review. Okay, so on January 12th, Vending Company sells 100 cameras for $100 each on account. They allow AMIA to return any unused cameras within 45 days of purchase. Okay, and the cost of each product is $60. They estimate that 3 products will be returned. The cost of recovering the products will be immaterial, and they can be resold again. So they return 2 of the customers because they were cameras because they're the wrong color, and they prepare financial statements, determines it's likely that only 1 more camera will be returned, etc. So just like bad debts, we need to make estimates of sales and sales returns. So please take a second to either pause the video to read it a little more slowly than I did. Well, let's talk about your journal entry. Notice this is extremely similar to what we've done. They sell 100 cameras for $100 each, accounts receivable, sales, cost of goods sold, inventory. Done it. No different than we've done it before. Okay? Next one, on to record the return of 2 cameras, I need to, let me go back to this entry. I basically am flipping this entry. Debiting sales revenue, crediting accounts receivable, debiting inventory, crediting cost of goods sold for the 2 cameras, with one exception. I want to keep track of my sales returns, so instead of just debiting sales, I debit sales returns and allowances. Make sure you know this is a contra asset. Or, I'm sorry, don't write that. It's a contra revenue. It'll always follow sales. So notice I'll have sales of 100, and then I'll subtract this 200, I'm sorry, the 2 that were returned. So I'll have sales of 10,000 less the 200, and so my net sales will be 9,800. So just like allowance always follows accounts receivable, just like the fair value adjustment always follows your investments, etc. Sales returns and allowances always follow sales around. So next one, they prepare their financial statements and they estimate that 1 more will be returned. So here's one thing that this is the new entry. These 2 should be review from a prior class. Now I need to estimate that I'm going to have 1 more. So I'm going to basically make the same journal entry here. Okay, notice I debited returned inventory. Not all companies debit returned inventory on this one. Sometimes they just put it back in inventory. But notice I can't exactly put it back in inventory because it's not in inventory, and that would be fraud. It's saying I have something that I don't have. So I'm sort of going to do this same journal entry, but I'm going to tweak it a little bit because this is a guess instead of knowing. This one's known, this one's a guess. So look, I still debit sales returns and allowances. I can't credit, go back to this one. I can't credit accounts receivable because I don't know whose it is. So notice whenever I credit accounts receivable, I have to put the person's name that no longer owes me money. So I can't do that. I know it's not inventory, etc. So let's talk about the journal entries. Sales returns and allowances stays the same. Cost of goods sold stays the same. However, I can't credit accounts receivable because I don't know whose it is, so I credit an allowance for sales returns and allowances, and I debit an estimated inventory returns. Okay, so again, it's just tweaking the journal entries, but thinking, oh, I can't put it back in inventory because I don't have it, so I need an estimated inventory returns. Okay. What happens, I already talked about this, the sales returns and allowances is net of sales. So I had 200 before, but I added another 100. So this is what our income statement is. So I have 9,700 of net sales minus my cost of goods sold. of 97. So if you made a T account of cost of goods sold, notice all three of them, even the estimated one, are coming out of cost of goods sold. And then my balance sheet, I'm going to have my accounts receivable minus my, honestly, we'll have two lines because you're going to have an allowance for doubtful accounts and an allowance for sales returns and allowances. And then also on the balance sheet, I'll have returned inventory, including an estimated. Okay. What if they sold the items for cash instead? So again, hopefully you would make this journal entry for the 100. Then I would have sales returns and allowances. Let me go back. Notice we got cash. So I can't credit accounts receivable, quite frankly, assuming that Venden did not pay cash at the time of the return. So quite frankly, a lot of times you just credit cash because you'd hand them back the cash. But in this case, it says they didn't pay them cash. I can't credit accounts receivable because I'm not removing it from accounts receivable. So I owe them a refund is basically what's happening here. So I'm putting into accounts payable. So just really take some time to think about what's going on. In the first case, if I can get to it here, I was taking it out of accounts receivable because I put it in accounts receivable. So now instead of owing me $10,000, they owe me $10,000 less $200. Just going to have them not pay their full bill. Whereas in this one, they've already paid me, so I owe them some of their money back. Okay, and so you can see that I've got a little bit different balance sheet, but it's just T accounts of the items. Okay, what is a repurchase agreement? A repurchase agreement is basically a financing transaction. So let me ask you this. What if you needed some cash? And so I said, hey, I'll buy your car from you. Okay, I'm going to buy your car from you for $2,000. I'm going to take that car and put it in my garage, and I promise to not drive that car. And in 2 weeks, if you get, a job or whatever, you can buy your car back for $2,200. Okay, so remember, I bought the car from you for $2,000. I'm going to keep it. I promise not to drive it. And I'm going to sell it back to you for $2,200. That is not a purchase and sale. That is an agreement that I loan you money, hold your car hostage as collateral, and then you pay me back for that car plus interest. So, if the obligation or right to repurchase is for an amount greater than or equal to the selling price, then the transaction is a financing transaction. Okay, so in your own words, it's a loan. It's a loan where I hold your car hostage. Okay, so we're going to go through one of these. They're an equipment dealer. They sell equipment on January 1st to Lane for $100,000. It agrees to repurchase his equipment on December 31st, 2018 for $121,000. So I hope your mind is thinking there is $21,000 of interest for the period January 1st to December 31st, 2018. That's 2 years of interest. So this $21,000 is 2 years of interest. You can probably even figure out what the interest rate is over paying $21,000 for 2 years of interest. But assuming that a 10% interest rate is imputed, I'm going to debit cash. Okay, remember I sold them this, and I credit you. It's no different than a loan, guys, but I can't call it a note payable because there's no note. So I say liability to Lane Company. You can even call it repurchase liability or some sort of payable under financing arrangement, payable under repurchase agreement, something that indicates this is a liability, but it's not a notes payable. Okay, so then on December 31st, 2017, remember I said that $21,000 is interest over 2 years. You could probably do it the straight line method and divide 21,000 divided by 2. They're probably going to actually take principal times rate times time. Anyway, I have 10%. So in the next one, I have principal times rate times time. 100,000 times 10% is 10,000. And then notice they're not paying it, so I'm going to add it to the liability. And then now my liability is 110,000 times 10%, so it's 11,000, and then I pay it off. Okay, so that's a repurchase agreement. Not that hard, except maybe terminology. Bill and hold. A bill and hold transaction is a contract in which the entity bills a customer for the product, but the entity retains physical possession of the product until a point in time in the future. Sometimes the buyer's not ready to take delivery, but does take title and accepts the building. So a lot of these bill and hold arrangements arise in a contract situation. So let's say that I was building a building, okay? And in that building, I need an elevator installed in the building. And so obviously, I want the elevator done and assembled and here when I need it. So how do I arrange for that? I tell them a date I want it delivered, okay? So I have told them I'm going to build a building this summer, and I have contracted with an elevator company to have a specialized elevator built for my building, and I want it delivered on June 30th because that's the day I'm going to install the elevator, or start installing the elevator. Well, weather gets in my way, and I am not ready for that elevator on the day I told them. So I may call them up and say, hey, I'm not ready for it. Now remember, they've made it. They really don't want that thing sitting around taking space in their shop. So I may technically have to pay them for storage because I don't want to take it and find storage. I don't want to bring it and me walk around it, etc. So I might take title to that elevator, but and I may pay for it, but whoever made me that elevator is keeping it. So that's a bill and hold arrangement. So Butler Company sells $450,000. It cost me $280,000 of fireplaces on March 1st to a local coffee shop, Baristo. They're planning to expand its locations around the city. Baristo asked Butler to retain the fireplaces in its warehouse until the new coffee shops are ready. Title passes to Baristo at the time the agreement is signed. When should they recognize it? Okay, they determine when they satisfy its performance obligation by evaluating who obtains control of that product. Okay, kind of sometimes it's the selling this one's not as hard as it actually seems. If you say, sure, well, can I resell it to somebody else? And, so maybe they only needed a sink. You just resell it to somebody else that comes along and make them another one. Then you still own it. It's not a big deal. But in the case of my elevator, if they've made it specially for me, they're going to look at me and say, yeah, you take it or you're going to pay me storage and you're going to be the one that insures it. Title has passed. Okay, in that case. Title has not passed if I can just sell it to somebody else. Okay, so when should they recognize? For Baristo to have obtained control of the product in a bill and hold arrangement, all of the following criterion should be met. The reason for the bill arrangement should be substantive. The product must be identified separately as belonging to Baristo. Remember, Baristo is the buyer. So in my case, the elevator was made specifically for me. It is identified separately. Okay. The reason is substantive because I cannot have that elevator sitting out in the weather. The product currently must be ready for physical transfer. It is. It's sitting there. I told them I'm not ready for it. And they cannot have the ability to use the product. This is the seller, Butler, cannot have the ability to use the product or direct it to another customer. So in the case of the sink, they can just sell it to somebody else. In the case of the elevator, they can't. So in this case, revenue recognition is permitted. I'm talking about the journal entry for Butler right here. And so they're going to go ahead and record the sale. A lot of times you could add to this. The Baristo is having to insure that product for damage or theft. They've kind of separated it out from all the others, and they can come and get it whenever they're ready for it. Okay, so I record the sale, accounts receivable, sales, cost of goods sold, inventory, right up here. Okay. Looks like I don't have the right slide number there. Consignments. Okay. A principal-agent relationship is if you sell something for somebody else. So notice here's their travel company facilitates booking a cruise for the cruise company. The principal, if you buy through Travelocity or Expedia, I guess they have Priceline as an agent for Hertz, etc. The amounts collected on behalf of the principal are not revenues of the agent. So anything that the travel company collects for the cruise company is not revenue to the travel company. They're going to get a cut off of this, but the cut is what is the revenue. So the revenue for the agent is the amount of commissions received. So that's a principal agent. Consignment, a lot of you guys have done consignment. Maybe you just didn't know it. If you take your clothes to a thrift store, you still own those goods. You can technically go pick them up unless you've signed an agreement that says you won't. But some thrift stores have you sign an agreement that says, okay, if they're not sold within 2 weeks, you either come in at the deadline of the 2 weeks and pick them up, or you agree that we can give them to Goodwill or someplace. So the consignor or manufacturer ships merchandise to the consignee, who acts as an agent for the consignor selling the merchandise. So in other words, if I make something and you have a little shop, you might sell it for me. If you can't sell it for me, you just ship it back to me. Okay, so the consignor makes a profit on the sale. We're the maker of it. They carry the merchandise on their inventory. It's still our inventory. We're just going to pay you a commission. So let's say you have a shop in a store and I make creative candles. Okay, so I may say, hey, can I sell my candles in your store? And you say, sure. Okay, because you've got an extra shelf up there. So I put my candles in your store. Sometimes I even go and set up the display and everything where you tell me to, because it's your store. You sell them for me. You give the revenue to me. You take a cut off of it, like 10% of it. And then at the end of Christmas, when I'm done with our length of time I'm going to sell it there, then I take them back. It's still my inventory. That's a consignment arrangement. So the consignor, think of it as the seller. The consignee is not the seller. Okay. So these are kind of a little bit complicated. So Nelba Manufacturing ships merchandise costing $36,000 on consignment to Best Value stores. Nelba pays, so make sure you get the consignor is Nelba. The consignee is Best Value. So the manufacturer has inventory of $36,000 and they pay freight on it. Okay. Best Value pays $22.50 for advertising costs that are reimbursable from Nelba. So they write the check for it, but Nelba's going to pay them back. By the end of the period, Best Value has sold 2/3 of the consigned merchandise for $40,000. Best Value notifies Nelba the sales, retains a 10% commission, and remits the cash. There's nothing really difficult to this, but you really got to keep on top of who has the merchandise, who owes who for what, etc., etc. So the consignor, Nelba, you've got these right over here. Shipment, they're going to debit inventory of consigned goods and take it out of finished goods inventory. Why are they doing this? All they're doing is separating it on their balance sheet or their financial statements, so I know how much inventory I have out there on consignment. So I don't, you can put consigned inventory out on consignment or whatever. So I'm taking it out of my normal inventory to put it in consigned inventory. And then I paid shipping. Okay, so freight in, this is technically freight in. Any cost to get the asset ready for its intended use is added to the cost of the asset. So I add that to the inventory. So hopefully that makes sense, and I'm just separating out this inventory. You could even put inventory on consignment at Best Value if you have consignment at several locations, so I can keep track of it. Next one, payment of advertising by consignee. Okay, there's no entry over here But this one, they paid the cash for $22.50 right here. And I have a receivable from the consignor because they're going to pay me back. So technically what's going to happen is when I settle up, I'm going to kind of net these all up and say, all right, I sold all of your goods, but I'm not going to give you back $22.50 because you owe me $22.50, and I'm not going to give you back the 10% because I said I was going to keep 10%. So we're just going to settle up at the end with, let's say I ask you, to sell my car for me, okay? I want you to sell my car for $10,000. You're going to pay me the $10,000 when you collect the cash. But you say, hey, I've got a chance I can put it, I have a lot of followers on my Twitter feed or whatever in the heck you have, and so I'm going to put a few advertisements out on Twitter, and I have to pay $50 for them. You want me to do that for you? And I say, sure. Okay, so remember, you're going to sell my car for $10,000. Okay, but you put some advertisements out there for $50. Okay, and then you're going to say, what are you going to pay me for selling it? And I'll say, well, I'll give you $100 if you sell that for me. So now you're out cash of $50 because you paid the advertising. You are going to get a commission for $100, and you sell my car for $10,000. What are you going to hand me back? Well, you're going to hand me back not $10,000. You're going to hand me back $10,000 less the $50 you paid for the advertising, and less your commission for $100. And that's what we're going to do here. So on the next one, let's go up here. They Best Values has sold 2/3 of the consigned merchandise for $40,000. So they get cash of $40,000, and they put it payable to the consignor. Okay? Notice that we could have put this as a debit and a payable, but we're probably going to net these two out in the end. Okay, so cash and payable to the consignor, and we have $22.50 that we're going to get from them, so we're going to net all that out in the end. And then I'm going to notify them that I sold the $40,000. Okay, so now I'm settling up. Okay, so think about it. I'm going to get rid of my payable to the consignor, $40,000. I'm going to net it against my receivable, get this one off my books for $22.50. I know that I'm getting a 10% commission, which is mine and my revenue. So 10% of $40,000 is $4. And so I'm going to hand them cash for $33,750. So in my example, you sold my car for $10,000, but you paid for $50 of advertising, so you're not paying me back that. And you have a $100 commission, so you're not paying me back that. So you're going to pay me, what, $98.50 or something like that. So get the payable off your books. Sorry. Get the payable off your books. Get the receivable off your books. Compute your commission revenue, and net the cash. So let's look at this side, which is basically sort of a mirror. They're going to get cash of $33,750. They're going to record consignment sales revenue of the $40,000. Okay? Then they're going to have commission expense for the $4,000. And remember, we never did put a payable on our books, but that was for advertising, so I'm going to have advertising expense. Okay, and then, so I've got my revenue entry, and now I need my cost of goods sold inventory entry. So back over here, it says the cost of the sales was $36,000. And they sold 2/3 of it. So I have $36,000 plus the $37.50 of freight costs that I'm going to add to the cost of the inventory, and I'll take it out of cost of goods sold. Another thing you could have done is back here, made a T account of inventory and put $36,000 in it, $37.50 in it, and then total it up. So we have $39,750 in our inventory, and taken 2/3 of the $39,750 that's in our inventory. Okay? So again, not really difficult, but you've got money going 2 and 3 ways, and sometimes you can get kind of caught up in it. Okay. These are always interesting to read, but you can read them. Okay, next one. Assurance type warranty and service type warranty, make sure you know the difference. The assurance type warranty is when I go buy a product from the store, let's say a TV, and it's got a 3-month warranty that I can take it back if it doesn't work. And then they will always ask me when I sell, you can purchase an extended warranty for an additional $40. That's the service type warranty. So one is included in the sales price, one is not. So when we think about the performance obligations, I can't separate this one out from the TV, but I can separate this one out for the TV, so it's a separate performance obligation. Okay, so make sure you get some of these written out over here. So Mavericks sold 1,000 Rolomatics on October 1st at a total price of $6 million. So I would actually, if you are doing this, I would actually write this out to the side. 1,000 Rolomatics at a total price of $6 million. We might we might need the individual price of $6,000. Anyway, I'd write that outside there. 1,000 October 1st, 1,000 sales of 1,000 at total $6 million, with a warranty guarantee that the product was free of defects. The cost of the Rolomatics is $4 million, so put $4 million as my cost of goods sold. The terms of the assurance warranty is 2 years with an estimated cost of $80,000. Write that there. The cost of my warranty is $80,000. It's not what I'm charging them for them. That's what it cost me. So that's the, go back here. Oops. That's the assurance type warranty right there. Then I have on November 22nd, they incurred labor costs of $3,000 and parts costs of $25,000 related to the assurance warranty. So write that out there. November 22nd, spent $3,000 and $25,000 on warranties. They prepare the financial statements on December 31st, and it estimates the future assurance warranty costs will total $44,000. Okay, I think I skipped this. They also sold extended warranties related to 400 Rolomatics for 3 years beyond the 2-year period for $18,000. So I have my service type warranty is 400, and it's an additional 3 years for $18,000. Okay, so let's do the journal entries. There are 3 here. The first one, I have 2 performance obligations. Okay, one, it's the assurance type warranty that's part of it. So I had $6 million on that one. Okay, and I have sales revenue of $6 million. Then I'm going to add on this $18,000 for the separate performance obligation. So I got cash of $6,018,000, and that one is unearned warranty revenue because I haven't done anything on it. Okay. Next one is I record my cost of goods sold inventory of $4,000. Okay, so now then, on November 22, 2017, so notice I'm still in the assurance warranty period on this one. I have wages expense, wages payable, I'm sorry, not wages expense, warranty expense of $28,000, which is the salaries and wages of $3,000 I paid to get people to fix these things, and the inventory I had to take out and give because I had to fix these things. So this inventory could be of parts, but quite frankly, I could be giving them new Rolomatics or whatever in the world a Rolomatic is. So if this was TV, I could be actually giving somebody brand new TVs because it was so broken that I couldn't fix it, or I could be giving them parts. Okay, then at December 31st, remember my service type warranty, this $18,000 has not kicked into effect yet because it is 3 years beyond the 2-year. By December 31st, 2017, I'm still in the 2 years. Okay, so notice this had an estimated cost of $80,000. Hopefully you wrote that out there. I'm picking up the wrong numbers. Okay, So it estimates at the end of the year that its future assurance warranty cost will be a total of $44,000. Of it, I was trying to separate these two, and you can't separate them because they're integral in one contract. The assurance type warranty is not separated out from the sales. Okay, so I have to estimate how much, just like I have to estimate my bad debts, and I estimate my warranties, and at year end I'm estimating $44,000 that I will still have. So I debit warranty expense and warranty liabilities. So this one, the expense is an estimate. Okay, so basically what I have is on my warranty, I have $28,000 that I've spent, and I have $44,000 that I think I'm going to spend next year, $72,000. So notice this is 2 years, so October 1st to December 31st is only 3 months. How do I come up with this $44,000? Well, I have no idea how they guess at that, but even if I took $28,000 divided by 3 months, it's 9,333 times 12 months. That would be 112,000. So they must think the warranties are going to come in the first few months more than at the end of the 2 years. Okay, so this is the estimated future warranty costs. Okay. Next one. Oh, let's go up here. Let me go back on this one. We're going to, in the end, also have estimated warranty costs related. That's going to go out an additional 3 years. And I thought it did this one. That was. We're going to earn this warranty revenue not in years 1 and 2, but in years 3, 4, and 5. We're going to take out 1/3 of the $18,000 a year, take it out of unearned revenue, put it into earned revenue, and keep estimating these warranty costs. All right, non-refundable upfront fees. I'll have to see how much longer we have yet. Non-refundable upfront fees are payments from customers before delivery of a product or performance of a service. Do we have setup of a good, et cetera, et cetera. So, such as membership fee in a health club, activation fees for phone or internet cable. What do you do with those? Okay, so we're going to actually do one here. I think I just added this. Erica Felice signs a 1-year contract to Bigelow Health Club. The terms of the contract are that Erica is required to pay a non-refundable initiation fee of $200 and an annual membership fee of $50 per month. Bigelow determines that its customers on average renew their annual membership 2 times before terminating their membership. So in other words, we need to figure out how long that non-refundable initiation fee covers to recognize the revenue. So what is the revenue in the first year? This is viewed as a single performance obligation. The total transaction price is $2,000 and covers all 3 years. And it is upfront fee of, I guess they're going to renew it 2 more times, so I have 3 years of membership. So I have 36 months at $50 each is the normal membership life. And so I have revenue for each month is $2,000 divided by 36, $55.56 each month. And so what is my revenue in the first year? Well, it says we signed a 1-year contract. So let's pretend that she signed that in January. So I'd have $55.56 times 12. If she signed it in November, she would have $55.56 times November, December, so 2 months. Okay, so contract assets. So we have contract assets are unconditional rights to receive consideration because the company has satisfied its performance obligation, or conditional rights to receive consideration because it's satisfied one performance obligation but must satisfy another performance obligation before it can bill the customer. So that's kind of a little bit out there and confusing. You can see that you can write accounting rules to be kind of confusing. But let's give an example. On January 1st, Finn Company enters in a contract to transfer product A and product B to Overmind for $100,000. The contract specifies that payment of product A will not occur until product B is also delivered. In other words, payment will not occur until both products are transferred. FINS determines that the standalone prices for product A are $70,000, $30,000, and $70,000, and they deliver the products on February 1st and March 1st. So what journal entries would they make in regarding to this? Okay, so the first one on February 1st, so please write down the dates. January 1st, they enter into a contract. They deliver it on February 1st and March 1st. Okay, so what journal entries should FIN make? This is the seller. So they have sales revenue of $30,000. Notice that we don't really put it in accounts receivable. I don't really like the word contract asset because it kind of implies it's a fixed asset. So you could put contract asset or contract asset of accounts receivable. But anyway, so on February 1st, they do not record the accounts receivable because it does not have an unconditional right to receive the $100,000 unless it also transfers product B. But when they transfer product B, then that triggers the $100,000. So you might want to put contract asset, put pending accounts receivable. Maybe that's a better word for it. Contract asset dash pending accounts receivable. So then we have debit our accounts receivable on March 1st, record our sales revenue for the separate one, and record get your contract asset off your books. What about a contract liability? On March 1st, Henley Company enters into a contract to transfer a product to Propel Inc. on July 31st. It's agreed that Propel will pay the full price of $10,000 in advance, and they deliver the product on July 1st, and the cost of the product is $7,500. So instead of getting paid later, I'm getting paid earlier, but I technically don't earn it until I have delivered it. So what is the journal entry on March 1st? I've just entered into a contract. By the way, you will put this stuff in your notes to your financial statements, but we don't make a journal entry for it. Then on April 15th, I get cash, but I haven't earned anything yet, so I put it in unearned sales revenue. That makes a lot more sense than contract asset. On satisfying the performance obligation, I take it out of unearned, put it into earned, and then I can record the cost of goods sold inventory. So hopefully that one seems a little bit easier than the other one. Contract modifications, what you would do is determine whether it's a new and separate contract or whether it's a modification of the existing contract. So that's what you need to determine on that. If it's a separate performance obligation, the promised goods or services are distinct, and the company has a right to receive an amount of consideration that reflects the standalone selling price. Again, confusing wording, maybe you just need to do one. Crandall Company has a contract to sell 100 products at a customer for $10,000, $100 per product at various points in time. So hopefully you're writing this out here. 100 products times $100 equals $10,000 over a 6-month period. After 60 products have been delivered, so I own 40 more, they modify the contract promising to deliver 20 more products for an additional $1,900 or $95 selling price, which is the standalone selling price of the contract, etc. So what happens is our original contract, we sold them, we're going to sell them 100, but we're going to sell them to deliver 20 more products, etc. Okay, so I think we need to be really clear here whether we're getting the 40 or we're changing the 40 to 20 is kind of important here. In this case, we are giving the additional 40. So look, 100 minus 60. So I have 40 times 4,000. My new products are 95, so I have 5,900 of those. Okay. So the question is, what should they do with this? Let's go ahead to the journal entries. So products not delivered, under the original contract, so we have $4,000, and then we have 95. So what happens now is you want to average that and pretend that every one of the remaining ones under the contract are 98.33. So we have 40. We could make two columns here. Number of units, dollars. So number of units is 40, 4,000. Number of units, 20, 1,900. Total of 60 products, 5,900. So now they're at 98.33. So our revenue recognition is now separate performance obligations, 11,900 and 11,900. Wow. This one? Yes. No, I really have any things to add. Collectability. The collectability is important. The amount of revenue recognized is not adjusted for customer credit risk. However, we do make allowances, etc. It's actually a consideration for determining revenue recognition, but you don't, if your customer risk changes, you don't adjust it. Let's see. What do you have to disclose? You have to disclose some contracts with customers. You have to disclose those significant judgments you're making about collectability, etc. Any contract assets, those type of things. A full range of disclosures. Some reconciliations, some remaining balances of performance obligations. So like I agreed to sell somebody 2 million tons and I've done 1.8 million, so I have to say, okay, I've got 2 million left on it. Any significant judgments, etc. So kind of whatever in the world readers would want to know in your financial statements about these revenue recognitions. So kind of a good answer for disclosure is whenever there's a judgment call, there's a disclosure, a related disclosure. And we are done. So, hope you enjoyed this.